Hi, everyone. This is Mike DeBliss. This podcast is on the topic of civil criminal coordination, the important interconnections between civil tax and criminal tax. It's a fascinating topic because it speaks to the civil tax penalties and the impact that a conviction for a tax crime has on the examination and assessment of civil tax penalties. So it's going to consist of an overview of and a little bit of background information on the various tax penalties and how they are impacted by a conviction. We'll also discuss a little bit of collateral estoppel insofar as a conviction for a tax crime has on the government's burden of proving fraud for purposes of the civil tax fraud penalty, which is the 800-pound gorilla of all tax penalties. Let me give you a little bit of background information so we can put all of this in its right context. Historically, the government has proceeded with criminal tax investigation and prosecution first, suspending audit and collection until after the criminal proceedings. That's the policy. And this policy reflects several considerations. The most important consideration is that civil discovery could reveal too much of the government's case too soon. And it's more of a strategic consideration that influences this policy. The government is concerned that taxpayers could use civil discovery procedures to find out more about its case than the criminal discovery procedures allowed. And that was the reason why the government worked up their criminal investigation and prosecution first, suspending audit and collection until after the criminal proceedings had ended. Well, the rationale for that has kind of been diminished. Prosecutors today are freer in what they will voluntarily disclose, and for good reason. A lot of prosecutors have been admonished by the federal courts and by the judges for failing to disclose information that the defendant was entitled to. So today, the government tends to turn over most every piece of evidence, especially if it has, even in the least bit, the tendency to exculpate the defendant. No prosecutor wants to be in a position where they're being admonished by the court and possibly even disbarred for an ethical violation of their reciprocal duty to turn over to the defense discovery that it's entitled to, especially discovery that tends to exculpate the defendant. So this policy consideration of revealing too much too soon as the basis for proceeding with the criminal tax investigation and prosecution first has kind of been eroded. Nonetheless, the government adheres to its traditional practice of doing the criminal side first. There is an exception to that. The exception to that practice is tax shelter cases. The government tends to work the civil and criminal side simultaneously, but outside of the tax shelter context, the historical policy of criminal first, civil later is the recognized pattern. Now, even if the government doesn't suspend civil proceedings, a judge might. So in the unlikely case where the government doesn't suspend the civil proceedings, the judge might. And the reason why is because the judge might be concerned that the government might use the civil proceedings to force the taxpayer to either waive his Fifth Amendment privilege against self-incrimination or face some stiff penalty in the civil proceeding. So the judge, has a concern that the defendant taxpayer could be put in a very unfair position where they're forced to waive their Fifth Amendment privilege or face a stiff penalty in the civil proceedings. And so a judge might mitigate this concern by staying the civil case pending resolution of the prosecution. And essentially that just means adjourning the civil case until the criminal case has ended. Now let's talk a little bit about civil liability and pleas. A judge may be more inclined to allow a downward adjustment for acceptance of responsibility if the taxpayer defendant has paid or agreed to pay the tax liability. At the same time, taxpayer loses nothing. A payment is not an admission of liability or an admission that the limitations period remains open. The taxpayer still has the right to argue about liability later, post-conviction that is, and paying the tax does not eliminate the possibility of adjudicating the matter civilly. Taxpayer can always file a refund claim with the IRS. Now, what happens when the government gets around to the civil side? Well, it will assert against the taxpayer not just deficiency in interest, but also civil penalties. And what I'm going to do now is cover the various civil tax penalties that the government will assess when it gets around to the civil tax case. In this instance, we're going to assume that our taxpayer has been convicted of a tax crime unless I indicate otherwise, and now we are moving on to the civil portion of the case. So even though the government may have gotten its pound of flesh out of the defendant in the criminal tax case via a conviction, the government isn't going to let go or simply leave the defendant alone. The government is going to assert against the taxpayer a deficiency and interest and civil penalties. So there's going to be two stages to this. The criminal stage, where the defendant was criminally prosecuted, and now the civil phase, where the government is coming after the deficiency, interest, and the civil penalties. So again, just because a defendant has been convicted and may even be going to jail and serving a stiff prison sentence, that in no way will deter the government from dropping its civil tax case. So let's begin with the civil fraud penalty. This is the most frequently asserted civil penalty. It is by far the 800-pound gorilla of civil tax penalties. And the reason why is because the civil fraud penalty is the largest civil tax penalty in dollar amount. When I speak to the largest civil tax penalty, I'm referring to 75% of the understatement attributable to fraud. The second reason why this penalty gets such a bad rap is because when fraud is established, there is no statute of limitation impediment to the assessment of civil liability. So the tiniest bit of fraud will simply swallow up any statute of limitation impediment to the assessment of civil liabilities, meaning that even if the 3-year period of statute of limitations has passed, the government can still assess a civil fraud penalty. So fraud freezes the statute of limitation and statute of limitations such that it can no longer be a defense to the taxpayer. And the third reason is that a determination of fraud undercuts the possibility of a taxpayer discharging liabilities in a later bankruptcy proceeding. So the exception to the taxpayer's ability to discharge civil tax liability in a bankruptcy proceeding is a determination of fraud. Again, a determination of fraud obliviates any opportunity that the taxpayer may have of discharging the civil fraud penalty in a bankruptcy proceeding. And there is a fourth reason why this penalty is the Grinch that stole Christmas. Although the burden of proof as to civil fraud is higher than that for other civil penalties, it's lower than the burden for criminal fraud. As I discussed in an earlier podcast, in the criminal realm, the government has to prove each and every element of the crime beyond a reasonable doubt. But the burden of proof for the civil fraud penalty is by clear and convincing evidence. So there's a hierarchy, and I've discussed that as well in some of the earlier podcasts. The first is preponderance of the evidence. The second is clear and convincing evidence. And the third is beyond a reasonable doubt. As we get higher up that pyramid, the boulder becomes larger and harder for the person to roll up the mountain. And that's the visual that I've always kept in my mind when it comes to the burden, especially when it comes to beyond a reasonable doubt, because the framers of the Constitution wanted to ensure that innocent people were not wrongfully convicted. And so that's why they made the burden and they considered the burden of beyond a reasonable doubt to be substantial. Some courts have actually defined it in terms of 80% certainty, but that varies from circuit to circuit. But it just goes to show you how difficult that boulder is when it comes to beyond a reasonable doubt. So let's circle back to the civil tax fraud penalty. Essentially, a taxpayer who fraudulently prevents or minimizes assessment of taxes may file a false return. It's in the filing of the false return that the civil fraud penalty applies. And I should say specifically that the civil fraud penalty applies only to filed returns. So how about the situation that arises when the taxpayer fails to file or files a late return? They tend to be penalized. Those two actions, failure to file and late filing, are penalized under a separate section, a separate tax penalty section of the code, and that's found under section 6651. The normal failure to file rate is 5% of the tax liability per month, and there is a ceiling. It's capped at 25%. When the failure to file is due to fraud, however, the delinquency penalty is raised from 5 to 15% per month, and the ceiling is also raised from 25 to 75%, and it's capped at 75%. So how about our filed returns? Section 6663, which is a section where the civil tax fraud penalty is found, imposes a penalty equal to 75% of the portion of the underpayment that is attributable to fraud. What tends to come up frequently in the context of the civil fraud penalty are joint returns involving married couples. Most married couples file joint returns, and a question that comes up frequently is whether fraud by one spouse can be attributed to the other. Under 6663C of the penalty, it states that the penalty applies only to the spouse who the IRS proves to have committed fraud. So if the IRS is able to prove fraud against the husband, for example, that does not mean that it automatically applies to the wife. What would have to happen is that the IRS would have to prove it against the husband and the wife. It cannot get a buy as to one of the spouses. So if it proves it against the husband, that does not mean that it's automatically attributed to the wife. In order to assert fraud against one spouse, once again, the government must have evidence of fraud as to that spouse. There is no imputed fraud. The wife does not become liable for the civil tax fraud penalty simply because the husband committed tax fraud and the government was able to prove it. If the government wants to pursue the wife for fraud, it must independently prove fraud as to the wife. Now, sometimes that results in a split. And what is interesting here is that the government, the IRS, that is, may issue a statutory notice of deficiency when it cranks up the civil case. And, just paraphrasing, the way this might look is that here's the amount of the deficiency with respect to the return. You are both liable for the deficiency. However, what the government might do is bifurcate this liability by stating, husband, you're liable for the civil tax fraud penalty under 6663. Wife, you're not off the hook entirely. You're not liable for the civil tax fraud penalty, but you are liable for the accuracy-related penalty under Section 6662. And as you will come to find out, that is also known as a 20% penalty. But suffice to say, the government has to prove fraud as to both spouses only if it asserts the fraud penalty against both. Now, if the government establishes, and this is what's very interesting because it's a little bit counterintuitive to what you might think. If the government establishes that any part of the underpayment is attributable to fraud, the burden of going forward then shifts to the taxpayer. So it's a very loose moving burden because any part of the underpayment attributable to fraud, it doesn't mean all of the underpayment attributable to fraud. It could be the tiniest fraction that the government is able to prove of the underpayment that is attributable to fraud. That would automatically shift the burden to the taxpayer, and then the burden of going forward is on the shoulders of the taxpayer. The taxpayer must then prove what portions of the return weren't attributable to fraud in order to reduce the understatement against which that 75% is applied. So that's how the dance works. Government establishes the tiniest fraction of the underpayment that is attributable to fraud. Burden then shifts, meaning that the government has essentially served up the first serve in the tennis match, and they've successfully proven even the tiniest part of the underpayment is attributable to fraud. The ball is now in the taxpayers section of the court, and that means that the burden has shifted to the taxpayer to prove what portions of the return weren't attributable to fraud. And only if the taxpayer can successfully hit that ball back to the government side of the court by meeting its burden, will the understatement be reduced? Will the understatement against which the 75% is applied be reduced? The question of how is fraud established comes up frequently. There are a number of ways. You've probably heard of the badges of fraud. They are numerous. Some of those include failing to maintain adequate books and records. It could be sloppy accounting. It could be sloppy record keeping. It could be the destruction of books and records that would otherwise have painted a roadmap to the fraud. And then fraud can be established by failing to file returns, concealing assets. Does imposing civil fraud penalty on top of a criminal tax penalty violate the double jeopardy clause? No. Some of you are familiar with the double jeopardy clause. It essentially means that a defendant cannot be tried for the same offense twice. So if the government has obtained a conviction against a defendant, say, for example, for tax evasion, the government can't come back 3 weeks, 3 months, 3 years, 100 years later and try the defendant for that very same tax evasion case. Double jeopardy kicks in. Equally so, if the defendant is acquitted of the charge, the government can't come back later on and try the case over again because it feels that the jury didn't see the evidence clearly or that the jury was a runaway jury. The government only gets one bite at the apple, and that's the law. What some of you may get confused with, and it is important to provide a distinction here, is with the fact that a hung jury, a case where the jury was unable to come to a unanimous decision. In those situations, the government has discretion to retry the case. So if there is a hung jury, meaning there's not a unanimous verdict, 12 jurors were unable to agree on whether the government had met its burden of proof and proved each and every element of the crime beyond a reasonable doubt. There could be even just one holdout. In that case, the judge would declare a mistrial. The government, in that case, reserves the right to retry the defendant on that offense if it chooses. In some cases, there is a subsequent trial. In other cases, the government may plea bargain the case or may dismiss the charges altogether. If you were following the Menendez case in New Jersey federal court, there was a mistrial declared on most of the counts of the indictment, and the government ultimately decided to dismiss those charges, and as a result, they did not go back to trial. Let's move on now to talk about the accuracy-related penalty. That's found under Section 6662. The accuracy-related penalty is an alternative to the fraud penalty. Under 6662A, the penalty amount is 20% of the underpayment. So it's radically different than the 75% civil tax fraud penalty. To be exact, it's 55% less, and it's 20% of the underpayment. The penalty applies whenever any of 6 conditions exist. I won't cover all of them, but I'll just give you a sampling of the first few. The first basis is negligent or intentional disregard of tax rules. The second basis is substantial understatement of income tax. And as part of the mechanism to finance Obamacare, there was legislation in 2010 that amended Section 6662 to add a sixth penalty basis. So before 2010, I believe there were only 5. And then in 2010, the legislature amended 6662 to add a sixth. That basis is a violation of the economic substance doctrine. And the significance of that is that it's a strict liability penalty, which means that there's really no defense against it. If you violated the economic substance doctrine, then there's an automatic assessment of the accuracy-related penalty. With the accuracy-related penalty, the government bears an initial burden of production. After the government does that, the burden of proof then shifts to the taxpayer to rebut the penalty. Typically, Section 6662 comes up in the civil criminal context in one of two ways. The first way is when the taxpayer defendant is acquitted for tax evasion. And sometimes I refer to tax evasion under the section of the code where it's found. It's Section 7201. So if you hear those numbers 7201 thrown about, that is referring to tax evasion, which is the 800-pound gorilla of criminal or of tax crimes, if you will. The government, in this case, we have a taxpayer who was initially charged under 7201, but acquitted. The government doesn't have a strong case of tax fraud when it gets to the civil side. So the government might then assert 6663, which the government might assert 6663, or in the alternative 6662. So remember, 6663 is our 800-pound gorilla of civil tax penalties. That is our civil tax fraud penalty. But 6662 is our accuracy-related penalty, and it could be a viable alternative for the government in a situation where the taxpayer is acquitted under 7201. Because keep in mind, the government has to prove fraud in a case of a civil tax fraud penalty. And even though the burden is lower for proving fraud for the civil tax fraud penalty than it is for proving willfulness under tax evasion, which must be proven under the standard of beyond a reasonable doubt, the government might still opt to assess the accuracy-related penalty for a defendant acquitted of tax evasion. So if the government loses the civil tax fraud penalty, at least it can get the accuracy-related penalty, which has a lower standard of proof. In the case of an accuracy-related penalty, the government need not prove fraud. The government might try to assess both penalties, and if the taxpayer decides to hold the government to its burden and forces the government to go to trial to prove the civil tax fraud penalty, and this would be in a civil context, the government would make out its case, but if it loses, it still has the opportunity of making out a case for the accuracy-related penalty, because the accuracy-related penalty doesn't require the government to prove fraud, and in that case has a lower standard of proof. Another context in which this accuracy-related penalty comes up is in the case of a jointly filed return. The government might think that it can prove fraud against one spouse but not the other. So what will it do? It'll assert fraud against one and the accuracy-related penalty against the other spouse. Delinquency penalties. The civil penalty for failing to timely file returns is found under 6651A1, and that's for delinquent penalties. How about some of the other civil penalties that we have? There are a myriad of other civil penalties that parallel criminal penalties or could apply in circumstances where criminal tax prosecution is on the horizon. There, for example, are a number of civil tax penalties that relate to tax advisors. I'll give you just two of them. 6694A penalizes income tax return preparers who negligently advise taxpayers, and based on that negligent advice, it results in the taxpayers making understatements on their returns. There's also Section 6700 that penalizes those who organize, sell interest in, or promote abusive tax shelters.